This is Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Bright and early Monday morning, start of a new week. I'm Prashant. With me, my colleagues Nigel and Sonia. Guys, hi, morning.
Hi, good morning, Prashant. Good morning, Nigel.
Morning.
And it's start of a brand new week. Looks like it's going to be a good one, given that the market momentum has been pretty strong. Earnings are not too bad. So let's see, we have our hands full. Global cues have been good as well.
Well, the markets are going to be, obviously the focal point, but I'm also going to keep an eye out on the India-England test match, right? It's interestingly poised out there. It appears we're on top, but we know what happened in the first test. So I'll keep an eye out there as well, and hopefully our boys come out on top. But Prashant, plenty
Well, that's a test. This is a one day, right?
This is
market. All right, let's just quickly tell you, just pick up from where we left off on Friday, because it's interesting how the market is poised. Number one, the Nifty cooled off significantly after making a new all-time high on Friday, last Friday that is. And it was a significant cool-off. And by the end of it, 0.75% looks very strong day on day, but from the day's high, it looked like actually a bit of a disappointment. In any case, I mean, there were strong markets. US markets saw a decent rally on Friday. The S&P was up 1%. The Nasdaq was up about 1.7, 1.8% or so. So equities in the US did quite well. Super strong jobs data, and you had which basically indicated that the economy in the US is in absolutely great shape. The numbers will come up on your screen. 350,000 jobs, right? And I think this is the third January in a row, right? I mean, last three Januaries where the actual number has been double what the market was expecting. So, I mean, blowout numbers, 3.7 unemployment rate, which is actually very low, and average hourly earnings. All three things which the market watches very closely came in stronger than expected. Now, markets have been kind of embracing this idea. Even Fed officials have been embracing this idea that there will be a soft landing, perfectly orchestrated landing, not too hot, not too cool, etc. And, we'll just get through this without a hitch, without a problem. I think that is at a bit of a risk in that sense. That narrative is going to be challenged. And the implication for markets and interest rates is, in any case, March rate cuts are down to, the probability of a March rate cut is down next to nothing. But this further pushes out the view that unless data slows substantially, maybe rate cuts will be down the line. It's not exactly a bad thing for equities. I'll get back to it in just a bit. Bond yields, by the way, jumped, and they jumped 14 basis points, the 10-year that is, to about 4% plus. Dollar index is back at about 104. You had oil prices, which actually sold off on Friday by 2%, and we are at about $77 a barrel. So, markets on Friday in the US were driven by the jobs number, and bulk of the activity, the frenzied activity happened on the rate side more than the equity side, which were higher in any case. The reason I'm saying, very strong numbers in the US is not bad news. Actually, it might be at the margin good. Think about it. You've got the Fed, which will cut. They've said they're thinking they're not thinking about hiking. They're thinking about cutting. The question is one. So when? The point is, it's a wait. So you've got a Fed which is on hold, but which will cut. So it's not exactly a bad outcome for the markets in that sense. Now, for the Nifty, just to come back to the levels, 22,470 will be the target on the way up. Of course, we made a new high, but which is, of course, the first resistance which the market will need to cross. It was about a 2-point higher high on Friday as compared to the previous high. But if you extend, the 138% of the total fall comes in at 22,470. That's the target, at which point you'll have to ask the question, has the market completed something? Support comes in at 21,747. These are levels around which, one would feel much more comfortable in terms of trading, getting in closer to these levels and not trying to chase the move up. Just one point, FII short positioning has come down. It's not come down massively, but 5 days back, it was 100,000 plus. It's about 75,000 odd contracts over the last 5 trading sessions. Bank Nifty's retraced 61.8% of the recent fall, and then it also saw selling pressure on Friday. The high on Bank Nifty on Friday, which is 46,892, becomes the first level which that index needs to cross on the way up. On the lower side, it should not break 45,850, which is again a retracement level. The GIFT Nifty will come up on your screen. I think there is a bit of profit taking, which is indicating about a 36, 37 odd point lower start, but neither here nor there in that sense. Sonia.
By the way, I thought, you guys are going to start by talking about that Apple Vision Pro and all the memes around it, right? It's spectacular.
Unreal.
Yeah, the price is unreal as well.
You want something unreal, Sonia, you have to pay an unreal price for it,
I
right?
agree. So are we going to be sitting with, in the future, in the next 5 years, no one's going to be seeing anyone
the
anymore?
good thing about that is, actually, we can't be sitting, right? The viewers have to be sitting.
The viewers will be sitting.
I mean, they can be anywhere. They don't have to be in front of the television screen. And we can be beamed into the glasses or whatever.
Yeah,
but it's crazy.
Technology is really evolving rapidly. Okay, we'll talk more about that later. But I think the momentum in the market does continue. And you can see that on the screen. You can see that with the Nifty hitting record highs on Friday. Of course, it came off from the highs. But nevertheless, if you look at the numbers as well, right, the flows, both foreign and domestic institutions bought in the cash markets on Friday. DI has bought almost 2,500 crores. So the money is coming in thick and fast. Now, the US markets were positive. It's been records after records for the, the Dow and the S&P 500. Dow was up 130 points on Friday as well. The only problem, as we've been telling you, is that the bond yields have been moving higher. So that's a bit of a sticky point. But otherwise, all the global factors, crude has been falling as well. So all that is in our favor. For our own markets, we've had some strong earnings that came through post-market hours on Friday. Tata Motors, Interglobe Aviation, Delivery. In fact, Tata Motors had multiple price upgrades. We'll talk about that later. JLR's guidance has been raised yet again, so that is important. And the management commentary was very, very positive. So Tata Motors is the stock to watch. Of course, it has been hitting new highs, so maybe some of that is already priced in. SBI was only the only sore thumb in this quarter's earnings. Weak earnings coming through. The operational miss came through because of that one-time pension provision, so we'll keep an eye out on that. But otherwise, very good set of numbers. Delivery reported its first ever profits. You have Indigo that reported a fifth consecutive quarter of profitability. So lots to talk about there. In earnings today, you have names like Bharti, Ashok Leyland, Tata Chemicals that will be reporting their numbers. So, the stage perhaps is set for the market to inch up higher. But looks like it's going to be a slow grind. This morning, at least, the Gift Nifty is a bit low on the lower side. But otherwise, the internals are all looking pretty strong for this market.
Well, that's right. So I just want to put a couple of data points. So I'll just hop across to the wall to make those points. The Nifty had a good session, mind you. But that knockout punch actually was missing in Friday's trading session. And the Nifty Bank as well, it looked good actually for majority of the week. But the problem was, it couldn't build on that. And it came off considerably as well on Friday's trading session. Well, this is something that I want to put out for our viewers. The Nifty all of last week, we saw it gradually move up, and just take a look at the short positioning. That kept coming in lower. So the short positioning from around 108 lakh contracts on the short side by the FIs, that came down to around 75,000 contracts. And by the way, the Nifty as well moved up. So as we always say, that the FIs being net short is not such a bad omen for the markets. What did they do on Friday's trading session? There was a delta of close to around 5,000 contracts because they added some mild long positions and they covered some shorts as well. Though they continue to remain net short with close to around 67% of their positions on the short side itself. Let's focus on a couple of key aspects. Sometimes your top batsman is not in form. So you say, let's, give it a bit of a rest and maybe hand over the baton to a couple of other players. That could be what's happening for HDFC Bank. Remember, it's the largest weight both on the Nifty as well as the Nifty Bank. And in the near term, maybe it's lacking those positive triggers. So just take a look at what's happened. On the Nifty Bank itself, we could possibly be having ICICI Bank that overtakes HDFC Bank. That may not be such a bad thing because you want to give, more of the strike to the batsman that's in form. And it appears, in the next few days, we could be bracing for that. Even on the Nifty, the Reliance Industries stock, well, that's been creeping up. From September itself, the gap between both them in terms of weightage was around 300 basis points or 3 or 4% odd. That's gradually started getting narrowed down as well. So that's another data point out there. Maybe HDFC Bank may be set to go ahead and in fact lose the top spot both on the Nifty and the Nifty Bank. What about the Nifty Bank? Well, the Nifty Bank seems to be facing resistance in that vicinity of around 46,500 because we visited that mark on Friday. We came off that mark and the 20 and the 50 DMA, intraday we did go higher than that, but we couldn't conquer that. So those are the crucial resistance levels on the Nifty Bank itself. Moving to the Nifty, well, we had, the 21,600 put that was fairly active. Big open interest build up. You had premium out there as well at around 57 rupees odd. And it appears that at least as of now, the 21,500 level, that's a crucial level on the downside. On the upside, the recent high that we made, 22,200 approximately, that's going to be the broad range for the Nifty itself. So that's about the key indices. The stock that I'm tracking today, going by the delivery data, as well as what's taken place in the F&O market, is ABFRL. In the last 1 year, it's been a rank underperformer. It's still lower than what it was a year ago. We're talking about this big party in the broader markets. Besides that, the delivery action out there was quite encouraging. Delivery volumes double of what we have seen. So, that's one factor. And even in the futures market, you had a massive surge in terms of open interest. In the past week, the open interest built up was to the tune of close to around 25%. So going by that, that's a stock that I'm tracking, guys.
All right. Thanks a lot, Nigel, for that. So lots in the news this morning. Let's kickstart the show very quickly. On the equities front, first up, we have Chetan Seth of Nomura, who says that there is now appears an increasing likelihood of a soft landing, Goldilocks for the US economy. He says this sets a positive backdrop for stocks, including some Asian markets such as India, Korea and Taiwan, while local factors are likely to be more dominant for other markets, including Hong Kong and China.
All right, well, that's the global view coming in. Ed Yardini is President Yardini Research. He's joining us right now to take some questions. Ed, great to have you with us here on the program. We, of course, have to start with the very super strong jobs data in the US and what that does to Fed pricing, etc. But for equities, what does it mean? Could it actually be a positive? Because, you've got a Fed which the next action is going to be cutting. And it's going to happen sometime. The question is when. And sometimes waiting is better than actually getting it. So is that the state that equities find themselves in? Go on.
Yeah, I agree with you. I think that the market has figured out that if the Federal Reserve is under no pressure to lower interest rates anytime soon, that implies that the economy is doing quite well. The Fed doesn't really want to lower interest rates prematurely. Inflation's coming down, but it hasn't exactly right on the money hit their 2% target. At the same time, the economy is showing that real GDP is growing very rapidly. And the other thing that's very exciting is productivity growth has really picked up over the last 3 quarters of 2023. So the Federal Reserve is in a very good shape to do nothing for a while here. And I tell you the truth, I wouldn't mind if interest rates just stay here because the economy is doing well, earnings are coming back, and the stock market decides that that's pretty a good environment.
Ed, hi, good morning, and thanks a lot for joining in. So what is the expectation from the Indian market? We have the budget that is now behind us. There's a big election coming up, and the narrative is that the government is, all for fiscal prudence as well as, looking at growth measures alongside.
Right.
How are you feeling about India now for the rest of the calendar year?
Well, the Indian market is discounted at a tremendous amount of good news, and there has been a tremendous amount of good news. And for now, we're seeing that India and other emerging markets that do not produce oil are enjoying a relatively low oil price right now as well. So I think the outlook for India's economy is good. I think it could be very good if we continue to see that the move out of China in terms of production is to the benefit of India. But the market has had a big run, and I wouldn't be surprised if there's some consolidation for a little while.
Ed, good morning. Good to see you. And Ed, how do you expect, emerging market central banks to, to behave in this sort of a backdrop? Because there's uncertainty when the Fed cuts and the quantum as well. We have a central bank, the RBI meets later this week. How do you expect, central banks like ours to behave?
Well, central banks around the world, whether it be in developed countries or emerging countries, do seem to have a certain amount of synchronity in the way that they manage their monetary policy. So I don't think that emerging markets are going to want to rush to lower rates here. Inflation is still a problem in a lot of countries. It's coming down, but it's still a problem. So I wouldn't be surprised if we see sort of a worldwide pause in central banks tightening, and I don't think they're going to be rushing to easing.
All right, we'll leave it at that, Ed. Thanks a lot for joining in. Appreciate your quick thoughts on the market. Well, that's the word coming in the macro economy. Let's do one thing. Let's take a quick commercial break. On the other side, plenty of stocks lined up for you. We'll be back in a bit. Welcome back to Bazaar Morning Call. Lots of stocks in focus. First up, SBI had some disappointment in their numbers. Ritu is here to give us the fine print. Ritu, morning.
Good morning, Sonia. Yes, the numbers were below street expectations. Profits declined by about 35%, but this was also because of a one-time exceptional item of 7,100 crores in the quarter, mainly because of pension and DA relief-related provisions. The net interest income was up about 4.5%, while the other income remained flat in the quarter. The gross advances growth for SBI, that was strong at about 14.38% year-on-year, while the deposit growth was at 13.02% year-on-year. But sequentially, if you look at the deposit growth, it was quite weak at just 1.56%, below some of its peers. In fact, the CASA ratio even fell by 7 basis points in the quarter. But the management said that this fall was because of flow of funds from savings to term deposits, and they don't really expect any major increase in the deposit rates going ahead. As for the advances, they've given us a guidance of 14 to 16% credit growth for the full year, with about 4.6 lakh crores in the pipeline as far as the loans were concerned. Now, margins continue to decline for SBI, as we've been seeing across the spectrum, coming in at 3.22% for the quarter, down 7 basis points. Now, in their interview to us, SBI did indicate that even with some deposit repricing that is left, there will be no more than 2 to 3 basis point hit on the margins. Asset quality improved. Gross NPA is at 2.42% and net NPA flat sequentially at 0.64%. Slippages came down to rose to 5,046 crores. But there was a pullback of about 900 crores in the quarter. This was largely on account of one large SME account which slipped, which the bank will look to restructure. Capital is comfortable, but the management indicated they may raise some equity if there was a need. There was a 70 basis point hit on the overall capital adequacy because of the higher risk weights. They've also indicated, that in future, perhaps they expect an improvement in deposit growth and maintain the asset quality at the current levels.
All right, thanks a lot for that, Ritu. Well, I'm going with deep green for Tata Motors because there was no fault in these numbers at all. Spectacular set of numbers is what the company reported this time, and there have been multiple price upgrades that have come in on Tata Motors. So let's just go through the earnings. Big beat compared to analyst estimates as well as what they did same time last year. So the JLR EBITDA margins came in at 16.2%. The estimate was 15.1%. It's a 430 basis points year-on-year bump up in JLR EBITDA margins. And this is the second consecutive quarter that the company has raised their EBIT margin estimates. The guidance for the full year has been raised. Earlier, they said that the EBIT margins will be about 8%. Now they've said that the EBIT margins will be 8% plus. So this is the second quarter that they have raised their EBIT margin guidance. They continue to expect operating cash flows to support the net debt of less than £1 billion by the end of FY24. And they have stuck to their guidance of net cash positive by FY25. The key numbers will be there for you on your screen. Consolidated revenue growth of 25%, core EBITDA up 43%. Consolidated margins have improved 300 basis points year-on-year at 13.9%. And the profit is a big beat, coming in at 7,000 crores versus 2,958 crores same time last year. Even JLR's, numbers have been very strong. So going with green over there.
Okay, all right. Green on Tata Motors. So that's the one we're going to be tracking. But the stock that refuses to leave the limelight is Paytm. Last 2 days, down in lower circuit. Ritu joins us to give us a quick update on that front. Ritu?
Nigel, from major irregularities in their KYC process to submission of false compliance reports, concerns about the group's commitment to principles of transparency. I mean, there have been a series of lapses, we understand, regulatory lapses, because of which RBI acted on Paytm Payment Bank, and these have, continued over the last 5 years. The first big concern is around the KYC anti-money laundering rules violation. While we understand there was absence of KYC for lakhs of customers, there was PAN validation failures, there were instances of one PAN being linked to more than 1,000 customer accounts. RBI's inspection, we understand, also shows that the total value of transactions was running into crores in some cases for accounts, which was far beyond what is allowed in minimum KYC wallets. There was also an unusually high number of dormant accounts. Our sources said as many as 31 crore out of 35 wallets were inoperative, and all this led to concerns about misuse, about money laundering concerns. The second big issue was the fact that the bank did not really maintain an arm's length distance in dealing with promoter group entities. The financial and non-financial businesses were commingled. There were, the bank also failed to disclose substantial payables to the parent entity, and all of this is why you saw RBI placing the bank under severe restrictions.
All right, Ritu, thank you very much for that. and we'll keep going back to her with more updates on this important story. UPL is another one which was going to be in focus. Numbers, of course, I mean, the loss was much greater than what was expected with UPL, but what next is the question for the stock. Sonal is here with some details. Sonal, morning.
Good morning, Prashant. Well, yes, the loss was bigger than expected, but the recovery, that has been pushed as well as per management. Let me take you the numbers first up. The revenues declined 28%. The EBITDA was down 86% on a YOY basis, much lower than estimates. The operating profit margins at 4.2%. That compares with a poll of 10.7% and compares with 22% on a YOY basis. The loss at 1,600 crore rupees were compared with a loss which was expected at around 483 crore rupees. The company says it was led by a pricing decline of 24%. The volumes declined 5%. The pressure continues as far as destocking is concerned. Their working capital days, they increased to 155 days versus 121 days, and they expect it to continue as well. The recovery is only expected from Q2 of FY25 versus the second half that they had expected earlier, so that's a bummer. Jefferies has cut the target price to 635 rupees a share. Nuvama has downgraded it to reduce. They've cut the target price as well, so the stocks should see some red today.
All right, thanks a lot for that. Well, a good set of numbers coming in from Interglobe Aviation this time around. In fact, if you look at the numbers, they were better than what the street was estimating. And it's the 5th consecutive quarter that Interglobe Aviation has reported profits. Now, no prizes for guessing this one. This industry has been booming, and that's factored into Interglobe Aviation, which has a monopoly in most routes in the metros especially. So if you look at it, the revenue growth has come in at 30% at 19,450 crores. The EBITDA, which is the EBITDA plus lease rentals, is up 61% at 5,475 crores. The core EBITDA has come in at 5,149 crores versus the estimate of 4,400 crores. The margins have improved to 26.4% versus 20.8%, and the profits have doubled year on year, coming in at little less than 3,000 crores versus 1,400 crores same time last year. The debt, although on a year-on-year basis, the debt has gone up. Sequentially, the debt has also come down. So, I think the street will go with a bright green on this one. But the other stock that could be bright green is Delivery. Reported profits for the first time ever. So, delivering this time, Mangalam.
Delivering this time indeed, and this seems like the season of all these new age companies turning around because, Delivery reported a profit for the first time. PB Fintech earlier reported a profit as well. And this is not all. It's also reported its highest ever quarterly revenue and EBITDA. So just to run you through the numbers, 20% jump in the revenue is what we saw, just shy of that 2,200 crore mark. The EBITDA came in at around 109 crores. This compares with a loss of 73 crores. And as a result of which, on the bottom line, there was a profit of nearly 12 crores versus a loss of nearly 200 crores same time last year. The internals were strong as well. Express business, which is the mainstay of the company, volumes grew 18%, revenue grew 21%. Part truckload business, so volumes grew 37%, revenue grew 37% as well. Full truckload business, which is a smaller part of the business, saw a revenue growth of 51% itself. Management commentary was positive too. So while we see a lot of green on Delivery on the back of these numbers, the only fly in the ointment is the potential supply that may come in from, SoftBank, which holds about 12% stake in the company. Remember, they've been selling stake last quarter as well. They sold about 2.7%.
Okay, all right. Mangalam, thanks a lot for that. Well, let's go back to Ritu. She's having a busy morning. She's here to tell us about how results from Bank of India as well as LIC Housing Finance looked. Ritu?
Nigel, Bank of India was below what the street was estimating, but the good part was the asset quality, which is the best that we've seen in at least 9 years or more. The profits were up about 62.4% and 1869 crores. The net interest income was down 2.4% at 5,463 crores. The net NPA improved sequentially to 1.41% and gross NPA at 5.35%. The deposit growth, that remained weak as we've been seeing across banks at a 9-quarter low. Deposits grew by just 0.6% sequentially, and the margins also continue to remain compressed despite that at 2.85%. As far as LIC Housing Finance is concerned, again, the P&L was above street estimates, but overall business momentum was not too strong. The profits came in at 1,162.9 crores. The net interest income was up by about 31% year on year at 2,097 crore rupees. Disbursements came down, year on year at 5.7%. They were up sequentially 3.5%. Gross NPA ratio improved just marginally to 4.26% and net NPA ratio at 2.24%.
Ritu, thanks very much for that as well. Now, Aurobindo Pharma and Torrent should be in focus as well. Ekta's got details on both. Ekta, morning.
Thanks for that. Well, yes, Aurobindo will continue to be in focus today because they have reported to the exchanges on Friday post-markets that the UGR Unit 3, which is basically earlier Unit 4, the one which was getting inspected, was inspected by the US FDA. It was issued 9 observations by the US FDA. And in fact, the company has decided to temporarily stop manufacturing on certain lines. So that should come in as a fresh negative. 9 observations plus stopping manufacturing on certain lines. But remember that the street probably already got a whiff of it because you could see it in the stock reaction. They've already started working with regulatory authorities, third-party consultants. At this time, they don't foresee any material impact on the business. Remember, this is a formulation manufacturing facility, one of the most important for Aurobindo, inspected from Jan 22nd to Feb 2nd. Maybe a little bit of something that could soothe nerves for Aurobindo. They're going to sell their business assets for one of their subsidiaries to Empower Clinic Services. They're going to receive $52 million on disposal of that. Torrent Pharma, EBITDA margins at all-time highs, US revenue down 7% year-on-year, but they have guided for sustained improvement in margins. Plus FY24, US may see a decline, but they're guiding for a pickup in FY25 with 6 to 7 launches planned, and that should probably keep the stock active today.
All right, thanks a lot for that. Let's take a quick break. On the other side, market expert Prakash Diwan will be joining in. We'll discuss all of these stocks and more, and we'll also talk about some of the other buzzing stocks in the news. Stay tuned.
Welcome back. Hope you're having a good morning. Well, we told you all about the equity markets and how things are shaping up. Well, let's get a quick roundup of what happened in the commodity markets. Manisha Gupta joins us to tell us exactly that. Morning, Manisha.
Morning, Nigel, and thank you for that. Well, the crude oil prices have seen a 6% weekly decline in the previous one, and we're trading flat right now. I mean, we did see a higher of almost $84 on the higher side, and we're holding it at 77 at this point in time. There is optimism over extended ceasefire between Israel and Gaza. Also, the strong U.S. jobs data has boosted the U.S. dollar. That is what's weighing onto the commodity markets early in Asia right now. Not just the crude oil prices, we've seen metals also start the week like that. The previous one also saw some declines, and this week as well, whether it's about copper, zinc, gold, silver also have seen declines continuing. The China Lunar New Year holidays are from 10th to 17th of Feb, so there's going to be lower action ahead of that. Also, traders have now totally, moved away from any rate cuts expectations in the month of March. And for the May as well, the expectations are at a lower 78%. And that's yet another thing that seems to be led to have profit taking in many of these commodities.
All right, thanks a lot, Manisha, for that. Well, moving on, Maruti registered a record high sales in January with total sales up 16% year-on-year, and exports are also up 37%. We spoke to Shashank Srivastava, the Senior Executive Officer, Marketing and Sales at Maruti Suzuki, and his commentary was not that great. He says that expect only a 7% growth for the entire industry in FY24, and in FY25, you can just expect a low single-digit growth for the passenger vehicle industry. Take a look.
The wholesale has been pretty good for the industry and of course for Maruti as well. Industry wholesale 395,000 against 346,000 of last year, showing a growth of 14%. In fact, the highest ever wholesale in any 1 month ever in the Indian passenger vehicle industry. So good performance on the wholesale front. It's not really surprising because, at the end of December, normally stock levels are very low. And a lot of wholesale happens to fill the inventory pipeline, which is generally very depleted at the beginning of any January. The inquiry levels, which is the first point that shows whether there is a stress in the system, has been okay. It's about 7-8% up for Maruti Suzuki, but the bookings have been about a couple of percentage less than last year. So we just have to wait on how things pan out in February to come to a conclusion of which way the retail is shaping up. And also remember, in this month, prices were increased by most OEMs, including Maruti Suzuki on the 16th of January. we don't see the trajectory reversing for some time. And we have done some research on our end, and basically on the affordability factor, the pace at which the price will increase and the pace at which the income levels of the households who purchase this type of vehicles will increase. And our expectation is that sometime in the second half of 2026, can we see a reversal, a bit of reversal in this segment. So even for the next year, we are not predicting a reversal of fortunes for this small car segment.
Okay, all right. Well, let's move on. Let's talk about some other stocks then that are going to be in focus today. Prakash Diwan joins us to help us out with some quick fundamental analysis. Hi, Prakash. Good morning. Let's talk about the big boy, SBI Card's numbers. It appeared it was marred by some one-offs with regard to the employee cost out there. But how would you view the stock at current prices?
Good morning, Nigel. So I think it's quite a few things that are not working for this particular name. And generally, given the fact that unsecured loans is under a little bit of a scanner of sorts or questionable, metrics that kind of RBI's, played out in terms of, or has announced to the street that this is something which will be watching very closely. Cards will, of course, be a problem. But if you look at, you'd rather focus on SBI, and that's also something where we're seeing a very clear trend, which is some large banks are grappling with in terms of compression on margins. And my sense is this would probably also reflect in the March quarter. But having said that, it's also going to be a very, very simple opportunity, big opportunity for people to buy into SBI at this point in time who don't have it in their long-term portfolios. Because from a longer-term valuation perspective, and the kind of growth opportunity that it sits on, they will be able to revive things very quickly as things improve on the credit side and on the cost of deposit side. So, we've seen that happen to some of the largest banks, whereas the mid-sized banks have got away with a little bit of an easier set of metrics. But my sense is SBI, if it gives you that dip, is probably going to be the last call to buy for the next 2 years. And then expect a very good outperformance relative to market, relative to other banks as well.
Well, the question really is, what do you do with Tata Motors, right, Prakash? Spectacular numbers, but the stock trajectory has also been equally good. I mean, it's doubled in the last 1 year. Do you think the risk-reward has become a bit unfavorable now, or is there more upsides?
Good morning, Sonia. I don't think so. There's any let-up in terms of the opportunity within Tata Motors. Remember one thing, and we spoke about this some time back, that I was expecting Tata Motors to report a very healthy number. And what's changed? What's changed is the JLR margins, which is the big elephant in the room in terms of what makes a big difference, what moves the needle for the company. Even the domestic market, if you see, except for the CV side, most of their PV launches, most of the PV expansion is happening at in a way that the margins will only improve. And with the price points coming down, Sonia, what happens is that your ability to pass on the fixed costs of the EV platform to each on a per vehicle basis starts kind of improving. And if that were to happen, you can imagine you have JLR margins coming back, you have coming into such a healthy state, you have the domestic margins, and this deleveraging thing would probably happen much earlier than what they've indicated. I mean, they've talked about FY25 end. My sense is middle of FY25, you'll probably start seeing the impact of that. So net cash, coming back into the books, it will give them a huge opportunity to kind of grow at a faster pace. So I think it's still got enough legs. I know the stock has run up, it's doubled in the last 1 year, more than that. But you still probably have the best bet in terms of visibility of earnings going forward from Tata Motors. So I had spoken about, at 700, that this is something which will give you 30-40% of an upside. I think it still holds true. You'll probably have a re-rating, and of course, the PE expansion will also follow.
Prakash, hi, morning. This entire travel theme is in sharp focus again, right? GMR, for example, rallied up some 8% on Friday. But then not GMR, I want your thoughts on Indigo, which reported numbers. And it's once again, they've beaten expectations, and it looks like a pretty good set overall. What's the best way to get exposure? There aren't very many options, right? I mean, there's, of course, the Adani Airports business, but that's part of the Adani Enterprises listed entity. There is GMR, there is Interglobe, SpiceJet, who knows? What are your thoughts here?
Good morning, Prashant. So first and foremost, what Indigo has reported or what Interglobe has reported is not much surprising. If you've been buying tickets for the last 2-3 months, you would realize what's led to this, healthy revenue, healthy beat on margins, profitability, all of that. What they will probably start doing is utilizing this buoyancy in their revenues and profit margins to actually deleverage more. And that is something which the market will definitely like, because that makes them much more competitively, better place in terms of a war chest. And remember, this whole shortage of aircraft supplies is actually turning out to be a very good benefit for them, while they themselves are impacted to a large extent in terms of their plans to expand. But it's inhibiting Air India and Vistara to grow as fast, which was the only threat that we perceived. I don't think from the airlines you would have any other choice. SpiceJet is still not kind of standing up on its feet and ready to run. So Interglobe does offer a good opportunity. Of course, the upside will probably be more limited as compared to what it used to be when it was around 24, 25, 2600 zones. But the way to play this entire theme, Prashant, is going to be there are a lot of allied services around airports, which you could look at. I mean, I know I'll just give you a couple of names, not that those are recommendations, but if you look at the way the DreamWorks expansion is happening, the network is expanding. Of course, they've compromised a lot on margins. They've not been able to kind of bring those things back up. But you look at, there's a company called Updater Services, very niche business. Of course, it does more than just airports. It supplies a lot of staffing services to airports. The number of airports that they're already present at and the way it's growing, it could be a very different dynamic. So I would believe, and by the way, it's not even very expensive as compared to what it was available at the time of the IPO. So this is one of those ignored IPO names from last year. You could probably look at that in a very different way. And if Indigo is growing, if Vistara is growing, and if everything else is flying high, there's got to be some some cascade effect on some of these vendors. So that's the way to play. But I would still buy Indigo, at least for the next 2 quarters. I don't see any issues till the competition starts intensifying with the supplies coming.
All right. Just stay on. I wanted your thoughts on Affle India, because the numbers have been very strong. So, Prakash, I'll come to you in a bit. We have the management joining in now. The company reported a strong revenue growth of 15% quarter-on-quarter, while the international revenue contribution also surged to 73%. Anuj Khanna Soham, the founder, chairman and CEO of Affle India, joins us now to discuss their Q3 performance. Anuj, hi, good morning, and thanks as always for being with us on CNBC-TV18. Well, the revenue growth year on year has been pretty strong. It's higher than the growth rates that you've seen in the preceding few quarters. Can you tell us what is the trajectory that you're looking at as we move along? What could be the average growth that Affle India kicks in by the end of, say, FY24 and then FY25?
Well, thank you for having me on your show. Good morning. Yes, we did really well in the last quarter, and I would like to say that 2023 was a very challenging year for us, in which we were able to provide a very transparent action plan on how we will turn around the company. So yes, the preceding quarters did not deliver as high a growth that we are used to, primarily because of developed markets and certain challenges that we had to overcome. But I'm glad to say that we have ended 2023 in the strongest way possible. And our financial balance sheet is stronger than ever before. Our intellectual balance sheet is stronger than ever before, with the patents in Gen AI, 15 of them filed last quarter. Looking forward, I think what would be reasonable and practical is to look at around 20% consistent top line, bottom line growth, with incremental margin expansion, because our company is really anchoring itself strongly on premium consumer platform conversions, delivering premium ROIs, therefore hoping that we can command premium pricing and better margins as we go along. So, that's the direction that we are going in. And I think we are in a very strong driving position.
Okay, so you're saying 20% growth is what you're looking at going forward on an average. But I want to understand a little bit about the international business, because last time you had said that the international business is a bit subdued because of, client spends reducing in places like US, Europe, etc. Have you seen any kind of recovery over there?
What I said to all our shareholders in Q1 in this financial year, it was in fact May 12th, if I remember correctly, that we have had internal issues in the organization in developed markets, for which we took decisive, timely actions, and we were very transparent about those actions being taken. where I took direct leadership on ground together with Anuj Kumar and our top management to go and fix things in the developed markets. And we gave ourselves a timeline to fix it by December 2023, and I'm glad that we were able to deliver on that promise. So our issues were more internal. But yes, from an external market outlook perspective, because our base is small, in developed markets, the addressable market is huge. Our products and business models are compelling. So given that the base is small, we can still extract good growth in that market. And we're seeing good potential for us.
Okay, body language as well is far better, I think, in comparison to what we spoke last time. Anuj, so you're sounding far more confident. A couple of questions. Out of the revenues that you delivered, you had done that acquisition, UAP. What was the contribution in the past quarter, if you could tell us in revenue terms?
I would say that, UAP acquisition has been a very successful integration. And unlike the earlier acquisitions, UAP was already in single-digit profits when we bought the company, and we have been able to inch that upwards consistently. And unlike our previous thesis, where we would take 3 years to integrate, we have managed to do the integration within 9 months very successfully. What I would like to just mention is that we are still calibrating UAP upwards in terms of profitability, while in terms of integration of revenue, we saw over 10 to 15% sequential growth overall together with UAP. Because last quarter also we had UAP, and this quarter we also had it combined. So if you compare, I think in terms of revenue growth, we are doing really well. 15 to 16% is very phenomenal. But even on profitability, we are calibrating it up.
Anuj, in revenue terms, it would be what, 80, 85 crores?
I don't have the exact number, but I know in terms of percentage, it is less than or around 15%.
Got it. Okay, all right.
Anuj, just a quick point. In the US, right, we just had numbers from Google. And that's the one company which kind of pointed to advertising revenue growth being a little subdued. Markets were disappointed. Can you talk to us if that's going to be an issue for you in 2024?
Look, I said very clearly, our products are differentiated. Our business model is unique and is very, very compelling. So when we go out there and deliver conversions and premium conversions to our advertisers, I think it's very compelling. And we are not looking for, huge budgets. Our base is small, and the addressable market is so large that I don't see a challenge in terms of at least getting our fair share of those budgets in those markets. Google is really not a comparison or Meta. These are companies which are much large bases. They're very anchored in developed markets. So, I think it's not a fair comparison to take any indicators from there.
Got it. Okay, just some quick numbers. Earlier, you said you would cross 1,800 crores of revenues by the end of FY24. Are you on track to do that? And if yes, what would the guidance be for FY25?
Well, I am not giving specific guidances. Let me just say in April 2024, we complete 18 years as a company. And I hope that when I come on the call next time that we would cross 1,800 crores.
All right. Anuj, you said UAP contributes 15%. I didn't get that. What was the 50, or it's growing at 15%?
I would say both. The number is about 15% contribution, 85% organic, 15% inorganic. And also that the sequential growth, I think sequential growth is about 10% or so, but 10 to 15% is the range that we are looking at from that lens.
And you also mentioned that, along with the 20% revenue growth that you're looking at, margin expansion as well is something that we could be talking about. Could you tell us what is the ideal margin?
That's our long-term strategy. We are going more premium. So when you go more premium, you work with premium inventories, premium ecosystem touch points, whether with iOS scan network or iOS App Store or other OEM app stores. So we are working really consistently, including CTV and going beyond mobile to connected devices. So in these areas, we can command premium pricing, but it will take time. It will require an investment phase. And that investment phase is perhaps what you're seeing. If you see our other expenses has gone up, this is not a negative sign. It shows that we are convincingly investing in sales and marketing efforts, and we will continue to do that.
Got it. All right, Anuj, all the best for the quarters to come. Thanks a lot for joining in and speaking to CNBC-TV18 about your earnings. That is the word coming in for Affle India. Let's step into a quick break. On the other side, Anuj Singhal will be joining in for a quick trade setup. Post that, will bring you the top stock picks for the day from our technical and F&O experts. Stay tuned.
Okay, welcome back. There's 10 minutes to go for the pre-open session. Anuj is here with a quick check on how he's looking at the trade setup. Anuj, morning.
Morning, Prashant. My basic sense is that you got to be a bit selective from here on for the market, because while the Nifty hit a new high on Friday, the Bank Nifty did not, and it's actually 6% off from its highs. The mid-cap index on the other end continues to see new highs, so that's perhaps a space to be in. Staying with momentum perhaps makes sense, and instead of trying to preempt what could move. Because the leaders of bull market normally remain same throughout, and PSUs have been the leaders of this market. So in that sense, it's important to perhaps stick to them. Of course, we'll see how SBI reacts today. The RBI monetary policy is going to be a big trigger from here on the 8th, because it's the first policy that would come out after the interim budget and the kind of reaction that we saw in the bond market. So I think that's something to keep an eye on. In terms of levels to watch on the Nifty, the first support is 21,805, Friday's low. And then, of course, you've got to keep an eye on the Thursday low, which was 21,658. On the upside, the first resistance would come in at 22,000, where you have the highest call writing build-up. And then 22,126, which was the all-time high, which we hit on Friday itself. On the Bank Nifty, I think it remains the problem point. On Friday, it fell almost 1,000 points intraday from the highs and closed at the low point of the day. So in that sense, it will be important to see how SBI moves and how it impacts the Bank Nifty today.
Okay, thanks a lot for that, Anuj. So big week coming up for the market, given that you have the RBI policy as well. But let's do one thing. Let's move on now and talk to Shrikant Chauhan and Kush Bora about the market setup and what they're expecting today. Shrikant, hi, good morning. Let me start with you. It's been a really solid, move that the market has had. Give and take a few volatile stretches here and there. But do you think at this price, at this level, almost at 22,000, is the risk reward still favorable?
Good morning, Sonia. Good morning, everyone. I think, at these levels, definitely the markets are going to spend some more time. So it is better always to buy if there is any correction in the market. So try to buy somewhere close to important support levels. And 21,700 is the level where we should look for adding some positions because there is huge amount of put writing, and also there are number of retracement ratios. But on the higher side, 22,000 and 22,050 will be important resistance zone. So at these levels, we need to be more and more stock specific. Let the market cross this level of 22,150 decisively. Then only we can expect rally towards 22,500, because now the market is now entering into that bigger trading range. Bank Nifty is also underperforming, so that the support from Bank Nifty is also required. And that's the reason we are of the view that we need to be more and more stock specific or buy if there is any correction.
All right, gentlemen, morning. Kush, what about you? How would you look at things this morning?
Hi, Prashant. A very good morning. Well, despite the profit booking that we saw on Friday, I'll take the closing about 28.50 as a very big positive. See, that was a very key resistance level. If you're able to hold on to that one, and let's say for this expiry, this weekly expiry, then 22,200 becomes a very real target and not just a touch and go kind of a move. So for me, this market is very clearly a buy on dips. And also, for all the chatter for Bank Nifty underperforming and not performing as everyone would have liked, from a purely technical standpoint, for the last few sessions, we are seeing a higher high, higher low kind of a formation, which is also suggesting that the supports on the Bank Nifty are also moving higher. Now, 46,500 is a very key level. That's where we are seeing the convergence of the 20-day moving average and the 50-day moving average. So for me, the view on the Nifty and the Bank Nifty is quite similar. Actually, it's a buy on dips kind of a market, or both the indices are in the buy on dips kind of a setup right now.
Okay, all right. Good morning, gentlemen. Kush, you go first. Tell us what's the stock on your radar?
A couple of them, Nigel. First one is Exide Industries. The stock been doing rather well. On Friday, we saw a positive move on the index on the back of very decent volumes. So I think from a near-term perspective, 355 and 365 are the targets that we should look at. 333 is where I would place my stop loss. The other stock is Midhani, Mishra Dhatu Nigam. The stock's been seeing consolidation for the past 4 or 5 sessions, but I think the momentum indicators and the volume indicators are suggesting a bit of positivity. So breakout is due here. 540 and 555 is where I would place my target, and 515 remains the stop loss.
All right, Shrikant, what about you? What would your stock ideas be for the day?
Yeah, I think we need to focus on metal companies, because there we are seeing good amount of buying attraction. And in that specifically, Steel Authority, which was underperforming since last almost few months, is now crossing its important hurdle on weekly, monthly basis, which is extremely positive for the stock. And based on its technical formation, we are of the view that it is heading for at least 140, 145 in the near term. So it's a buy at current levels. If there is any correction, then it will be an opportunity for traders to look for adding some positions. I think 124 should be the final stop loss for creating any long positions on Steel Authority. And we also like Tata Motors, because Tata Motors is like also forming higher top, higher bottom. After the result and based on its technical formation, I think it is heading for at least 950,000 in the near term. So at these levels, I think risk reward ratio is quite favorable. Buy at current levels with the stop loss at 860 on the downside.
All right. We'll come back to both of you in a bit. Srikanth and Kush, thank you for joining us right now. We'll take a quick commercial break here. Come back with the pre-open, which is 5 minutes away. Digant Haria, co-founder, Green Edge Wealth Services, will also be joining in. We'll talk about, of course, the SBI third quarter numbers, what it means for SBI and, of course, other PSU banks as well. And, of course, Paytm. What's the road ahead from here for that stock? Stay with us.
Welcome back to Bazaar Morning Call. Well, before we begin the day, let's do one thing. Let's quickly take you through the key headlines from our mega exclusive interview with the Finance Minister, Nirmala Sitharaman. The Finance Minister said that a 7% growth rate is not challenging and added that there was no slackness in the economy. She called on rating agencies to do their job after promising to stick to fiscal consolidation and urged them to take a comprehensive look at the economy. She also added that India needed to better data to capture the jobs market, as several jobs were not being captured in the current data. Sitharaman said that more work can be done on direct taxes when asked about the lack of relief to income taxpayers, but stopped short of saying if any relief will be provided in the next budget should the NDA return to power. On the issue of a possible rate cut, the Finance Minister said that the final call will be taken by the RBI and asserted that they would keep growth in mind while taking a decision. Listen in to a slice of a conversation with Network 18's Rahul Joshi.
I'm sure you'll be asked this question in future, but the allocation for capex at 11.1 lakh crore, does it seem like a lofty goal considering that you could not even do 10 lakh crore in this year?
No, but not really. I mean, we've done only 2 lakh, 3 lakh. That's not the case.
Yeah.
We're closer to 10. It's also because absorption has its own limits, whether it's the states or the departments within Government of India. When the capital expenditure is undertaken through the outlays given to them, it is only that much within 12 months that they can do and not beyond. So sometimes reaching the target, however ambitious it is to the last mile difficult within 12 months. Had we given them a few more months, they will probably even complete that. But the condition for these capital expenditure, which I have announced since last 3 years, is that amount should be utilized within the year. So many of the state governments which take the money, which are very good in implementing, in fact, I find states very enthusiastic in wanting to avail of this facility. The difficulty comes that if you restrict them to using it within 12 months, and which is what we aim at, we want them to use it within 12 months. So I'm not saying restrict in that sense, but within 12 months when you are expected to spend that money, there are times when completely utilizing it becomes difficult. They partly use it. That is why 10 lakhs you might reach 9.2 and not touch 10, but achieving 9.2 within a matter of 12 is, I think, good enough.
All right. Well, SBI's Q3 net profit as well was down close to 35% on a year-on-year basis because of a one-time exceptional charge. Although their asset quality improved and loan growth is at a 7-quarter high. Ritu Singh, my colleague, caught up with Mr. Dinesh Khara, the chairman of SBI, to discuss the past quarter's numbers as well as the outlook going ahead. Let's listen in to excerpts of that conversation.
We have provided additional about 6,100 crore in this quarter, which takes care of the liability at the rate of 17% from November 22 to December 23. And now we are required to make only one more provision of 5,400 crore for the last quarter. With that, our liability in fact, that will be only if at all it is not paid before during this period between January and March. Okay. Suppose if at all it would have been paid, then there are no additional provisions which are
There
required.
will be another one-time impact.
That's all, about 5,400 crore. So if you really look at it, it's 7,100 plus 6,000, about 13,000 crore. In the next quarter, we'll be required to provide only 5,400 crore. Our increase in interest rate has happened mostly in the term deposit. And that term deposit also, we generally see a significant portion of the term deposit coming in the 1 to 2 year bracket. And that is one of the reasons why I would say that since we have increased these interest rates somewhere in November, December, I would say that majority of the term deposits would have already got repriced. So only small bit of it would have been left out, which would be due for repricing. So that's the reason why I'm expecting that maybe it might have an impact of another maybe 2 to 3 basis points, not more than that. We are on track as far as the loan growth is growing at 14% plus. I think more than the number, we are very much cognizant of the quality which we would like to underwrite. As you have seen that our credit cost is 0.25%, and we would like to maintain this going forward. And with that in mind, we'll be little selective in terms of the credit risk which you undertake. Okay. But I would say that even now also, when it comes to the corporate credit, we have got a pipeline which is almost as strong as about 4.6 trillion. So we have...
Largely in the private sector.
Yeah, it was almost about 75% would be in the private sector and 25% would be in the public sector. So we are observing decent opportunities, but there's always some kind of a lag after the sanction and the disbursements. But nevertheless, we are seeing good traction as far as corporate book is concerned. SME, agri and retail, they are the one which are growing at a decent pace.
Okay, well, that's the largest bank in the country, State Bank of India. Digant Hariya is joining us, co-founder, Green Edge Wealth Services. Digant, great to have you with us here. Thank you very much for your time. State Bank of India, other PSU banks, let's start with SBI. What's your view on the numbers that we've got, some of the underlying growth numbers that we've seen, and what does it mean for the sector? I'll tell you why I'm asking that, because till SBI came out, it almost felt like PSU banks post the third quarter numbers will actually see earnings upgrades by the time the earnings season ends, as opposed to private banks which are largely disappointed. So just SBI and the broader PSU space, in your opinion.
Morning, Prashant. Good to be here. See this, I think your question itself has some answers that, let's see, SBI, we should think of this as one-off. See, whenever there's a wage negotiation or a wage revision which happens, once in 5 years, these things are expected. SBI had a slightly different pension accounting versus all other PSU banks, and which is why the hit with SBI is a little larger. But having said that, I would really like to ask you that, when in the history have we seen that, SBI's loan book rate is same or say a little higher than HDFC Bank? But we're seeing, that really playing out. So I would really think we should look at this whole employee expense pension provision as a one-off. And I think SBI is set, if we talk about next year, which is FY25, I think SBI is set to do profits anywhere between 60 to 70,000 crores. That's a very large number, something which we would never have thought of a year and a half back. And let's not forget, SBI is just not retail loans. These private sector banks are a lot dependent on retail loans. SBI can do a lot of corporate loans. The finance minister in her budget, it was very clear that, once elections are over, the private sector capex, the private sector growth will actually come back in the corporate space. And you will see SBI, delivering, mightily in the next year, which is FY25. So any weakness on this one-off kind of a result, I think one should definitely use it as a dips to buy. Your second question, Prashant, that...
Yeah, go ahead.
Your second question was that, it was looking as if the PSU banks will do much better than the private banks. You're absolutely bang on. See, the margin pressures on PSU banks have been very minimal when you compare it with the private sector banks. And even, on the growth front, they have not faltered too much. So I think the setup is really right that, when we have a deposit war, which the private sector banks will face, and, the slightly higher margin pressures, PSU banks are in a sweet spot. They do not have the deposit problem. Margin compression is less. And probably corporate growth pickup is just around the corner after elections. So I think PSU banks are set to, outperform the public sector banks. It's just that, SBI, Bob, PNB, the multiple difference has been so low. It has never been so low. So SBI should rally more, to regain its premium. That's our take on this PSU space.
Crystal clear then, Digant, on that. Fairly positive on the banking names and SBI in particular. Digant, I also want your view on Paytm. But for the time being, let's just do a quick revision of the news flow over the weekend. Ritu joins us to help us out with just that. Ritu?
Well, there have been a series of regulatory lapses by Paytm Payment Bank over the last 5 years, which have culminated in this RBI action against it. One of the big concerns has been around KYC rules and the violation of those, where we've been given to understand RBI found absence of KYC for lakhs of customers, PAN validation failures in lakhs of accounts, instances of a single PAN being linked to more than 1,000 customer accounts, for instance. Also, transactions running into crores, which is far beyond the limits allowed, and an unusually high number of dormant accounts, which are prone to have been used as mule accounts. In fact, we understand 30 out of 35 crore wallets, about 31 crore were inoperative, and therefore there were concerns relating to misuse in the form of money laundering by some, miscreants. To be clear, Paytm's customer accounts are under scrutiny because of weak regulatory compliance, leaving them prone to misuse. But there are no allegations or regulatory concerns relating to the company itself or its founder having indulged in money laundering activities. The second big concern was the fact that the bank did not maintain an arm's length distance in dealing with promoter group entities. Its financial, non-financial businesses were mingled. There were instances of false compliance reports being submitted by the bank and the bank failing to disclose substantial payables to the parent entity. 197 communication. All of this put together forced the RBI to act in the way it did.
Got it. All right, Ritu, thanks a lot for that, for making it pretty clear on all those parameters. Digant, what's your view? Paytm now at around 440 rupees approximately. What would you do, with the stock? Do you think at some point of time it becomes a buy, or do you think, there's too much of uncertainty out there, you'd rather just stay away?
Yeah, Nigel, morning. So, see, there is a lot of uncertainty and you will see some, lot of news flow coming in, like Ritu pointed out that, these were the lapses, more news flow will come out. But here, let's not forget that, Paytm, at the end of the day, it's a fast growing company. These are startups, they come from a very different mindset. So I think lapses are, going to be a part of their system, their DNA. It's just that, when you're growing very fast, these things happen. But there's a lot of value in the Paytm franchise, Nigel, that I would like to point out. Let's see, they have 4 crore active merchants on their platform, and 1 crore out of them have taken monthly subscriptions in the form of, those sound boxes or, other packages. Now, we always talked about that, India is a country of MSMEs. There are like crores of MSMEs, and it's a big space and big opportunity. Paytm actually has cracked that opportunity. It is just that it is not, it does not have an NBFC license. It's right now not on the right side of the law. And which is why, these whole, developing the SME ecosystem and winning there becomes a bit of a question mark. But, if we just think what happens 2-3 months later, either Paytm complies with whatever RBI has asked them to comply, and then they get back the permission from RBI to, restart their old businesses, or you have a new promoter which comes in place of the current promoter. Because below $400, I'm sure, the Reliance Jios of the world and Bajaj Finance or HDFC Axis Bank of the world, they would really be looking at Paytm very, very closely.
Sure. All right. Thanks a lot for that. Actually, we've run out of time, but thank you for your quick thoughts there. Let's get back to the market. The pre-opening rates are actually looking pretty good, and the top gainer on the index is Tata Motors. 7% higher now on Tata Motors. There have been multiple price upgrades that have come in post the strong earnings. So let's talk about that very quickly. Morgan Stanley has raised their target price to 1,013 on Tata Motors. Jefferies has a buy. They've raised their target price to 1,100. Jefferies, I think, is the most aggressive on the street with an 1,100 target price. HSBC and Goldman Sachs have raised their target prices to 920 and 960 respectively. The reasons for multiple upgrades: a second consecutive quarter of Tata Motors raising their EBIT guidance for JLR. Macquarie says the company has delivered on growth, margins, as well as on deleveraging. Goldman Sachs says that the net debt levels in JLR have declined by £675 million. And Jefferies says they expect a better Q4 led by seasonality and improving supplies at Jaguar Land Rover. So it's a win-win for Tata Motors. Big up move there.
All right. And the results that disappointed over the weekend were UPL, yet again, dare I say. But there is a bullish and a bearish case that's playing out there. Sonal, tell us both of them.
Well, yes, the numbers, as you said, were weak yet again. There is a big loss, much higher than what the street was working with at around 1,600 crore rupees versus an estimate of around 483 crore rupees. It was led by a volume decline, price decline of 24%. We had ongoing pricing pressure, and there were working capital days increase as well at 155 days versus 121 days. And management expects Q4 to be weak as well, and they expect recovery only from the second quarter of FY25. Now, Jefferies is a bear on the stock. They have cut the target price to 635 rupees a share. They expect normalized business only from Q2 versus first half of FY24. Thus, they've cut the FY25-26 EPS by 13 to 15%. Nomura has downgraded it to a reduce, cut the target price to 486 versus 716. They're cutting target multiples to 11 times, and they see a lot of pressure on the balance sheet as well. On the flip side, InCred says that buy aggressively on dips that you get. They've upgraded the stock to an ad with a target price of 694. They're saying all the agrochemical majors are hit by channel inventory issues. And at this time of the cycle, it's imperative to save balance sheet and vendor base. And that is exactly what UPL is doing by reducing their receivable days, leading to increase in their working capital days. And that's why they're bullish on the stock. And this is the only brokerage, actually, I believe, the ones that I've read, that have upgraded the stock after such a weak set of numbers.
Just one more point, the Nifty revision takes place, and this is the highest probability that it exits the Nifty in the current revision. So we'll wait for that announcement as well. That'll be a technical factor.
That last broker in InCred, right? I mean, the analyst at InCred, I think, is also the one which actually turned negative the first. I mean, in the entire chemical space. So, out of the brokers that Sonal listed, I kind of gave weightage to that one. Of course, I mean, so over a period of time. All right, Sonal, thanks very much for that. Aurobindo is the one that we're focused on next. Let's revisit it. Ekta's got details. Ekta, morning.
Thanks for that. Well, yes, Aurobindo has informed the exchanges on Friday post-markets that they concluded, or the USFT concluded, the inspection of Eugia Unit 3 or Unit 4 as it was called earlier. And the USFT has issued 9 observations to the facility. Now, most importantly, the company has indicated, and this happens rarely, that they have decided to temporarily stop manufacturing on certain lines. They have already started working with regulatory authorities and third-party consultants. The fact that they've stopped manufacturing on certain lines is indicative of the fact that, there could be some amount of remediation which they will have to go through with regards to this facility. We don't know the extent of it unless we get the Form 483. But remember that the stock had corrected in anticipation that this inspection is not going that well. So that's the reason why you could probably see more correction on Aurobindo. We'll wait by for the Form 483, which could be released in the next couple of days. It's a formulation facility, very important for Aurobindo, inspected from Jan 22nd to Feb 2nd.
All right, thanks a lot for that. We have just 1 second left for the market to open. And let me just hop across to the wall here to tell you about how the market opening is shaping up. Remember, the pre-opening rates have been pretty strong for the market. So it looks like the first tick on the index is also going to be a decent one. It's a flat opening for now, a tad bit in the green, as you can see over there. The Nifty holding on to the 21,860 mark. The Sensex as well, absolutely flat, not doing much at all. But let's take a look at some of the big gainers. Tata Motors is the big one to watch out for. In pre-opening, remember, there was a 7% rally that we saw in Tata Motors. There you have it, 4.5% higher on the back of a strong set of numbers coming through. Next up, on the downside, actually 2 stocks that I'm watching out for on the index. One is, of course, SBI, where the earnings were hit by one-time provision. So let's see how SBI has opened up this morning. It's a 1% cut just below that 650 mark on SBI. And after that, you have UPL, where, Sonal was just telling us about how the numbers are on the weaker side. So UPL is something that could be under pressure this morning, down almost 4.5%, so the big Nifty loser in trade, UPL there. Apart from that, Maruti was also dragging its feet in pre-opening. Remember, the management just told us a while back that there will be low single-digit growth for the passenger vehicle industry in FY25. So Maruti is really, not under pressure, but you'd have to say opened in the red, still hanging on to 10,600 for Maruti. And Aurobindo Pharma is the other one that I'm looking at. You just saw Ekta tell you about how the US FDA unit has been inspected. So Aurobindo Pharma, look at it, they're 4% lower. There's also some volume, hit that we're seeing on the downside over there. Indigo is the other stock that I want to look at this morning. Remember, there's been a 5th consecutive quarter of an up move in Indigo's profits. They have reported profitability for 5 quarters now, 4.5% higher. And talking about the profitability, first quarter profits for delivery. So that's another stock that we'll be looking at. Big moves coming into many of these, new age tech companies there. But okay, delivery down almost about 1.5%. But all in all, you'd have to say very, very flat opening. Of course, Nigel will take us through a couple of other numbers. There's Bank of India, there is Med Plus Health, all of them reacting to their earnings. But otherwise, the first tick on the index is absolutely flat right now. I think the drag is coming here on the Nifty Bank, which is down almost about 250 points now. That's courtesy SBI and a couple of other banks like ICICI Bank. Look at Bank of India. I think the director just showed me that stock. Big knock on Bank of India this morning, down almost about 7.5%. Back to you guys.
Well, that's right. In terms of the Nifty, the big loser really is UPL. The numbers look disappointing, and as we mentioned, that it could possibly be exiting the Nifty, going by the calculations. So that's one stock that's under big pressure. Stocks, besides that, stocks that are doing well today. NHPC, beautiful move out there. The stock is up close to around 10%. SJVN, big up move is what we're seeing on that stock. Just take a look at it. Massive volumes on that one. Nava Limited, well, it came out with its set of numbers late in trade on Friday. And that stock was trading high with a gain of 2.5% odd. It seems now the street is digesting those numbers. They're debt-free as well. So that explains why the big move that what we're seeing out there. IREDA, well, that stock is well up close to around 4.5%. It's a 200 rupees stock, IREDA. Just take a look at that. Did an OFS at, the listing at around 30-35 rupees odd. That stock is up and about in trade. SAIL continues its good form, so that's up close to around 3% as we speak. Paytm, the door is shut. Again, sellers at lower circuit, down close to around 10% approximately. What else is moving in trade? Well, you have NBCC that had opened up well in the green, but that's flattened out now. It's trading with a gain of just 1% or thereabouts. Metropolis had opened up in the red. That's moved into the green. Now that's up close to around 1%. And you have a couple of other notable movers in trade. Auto Pharma down close to 3.5%. And IOC, the OMCs continue to re-rate up close to around 3%. Prashant.
Nigel, it's a absolutely flat Nifty screen at about 2185. But look at what's going on in the rest of the market, right? Incredible. NHPC is up 12%, and Indigo is up almost 3,300 on Indigo. 3264 actually, to be precise. IREDA is up about 5%, 205. NLC, that's Neyveli Lignite, is up 5.5%. So, you got those elements of what did the best over the last many sessions, which is the PSU pack once again showing very clearly. Another one is Rate-Gain. Rate-Gain reported numbers, I think, during market hours on Friday. Stock went up sharply, some 6-7% within a matter of 10 minutes, and then it's up another 3% this morning. Numbers are very good. Satin Credit Care is up about 6%. VATech Vabag is up about 5%. KPI Green comes up with a 5% pop. And I think we mentioned Castrol, which is starting about 3.5 higher at this stage as well. On the downside, of course, there is Paytm, which is selling off a little bit. It's down, not a little bit, 10% again this morning. It's it's a low circuit now, 10% down. Bank of India, I don't know if you guys mentioned, 8% lower Bank of India, 139 on that one. And of course, UPL is down another 4%. It's a story of sort of constant disappointments there. And a turn will come, but it's kind of out of sight right now. And turn in business. EIL is down about 5%. So 247. Bandhan Bank starts about 2%, 2.5% lower. South Indian Bank, which has rallied quite a bit in very sharp ways, down about 2.5%. And Tube Investments is down about 8% as well. So keep an eye out on that one as we move forward. So more on this in terms of specific stocks, etc. But it's a very vibrant open. There are more gainers than losers. 1,300 stocks are higher, 780 stocks are down, but it's vibrant. And a lot of volume, a lot of activity, the kind of market open that you would like to see. Lawrence Belanco of CLSA is now joining in, somebody who tracks price action very closely and is also followed very closely by both who track technicals but also those who track fundamentals. Lawrence, great to have you with us here, and always great to get your views on CNBC TV18. We on Friday hit a new high, all-time high, just about a 2-3 point higher high compared to the previous one, and then there was a significant cool-off. Are we at a bit of a crossroads? Do you think there is enough in the tank for the market to continue marching higher? What's your view?
Yeah, look, in the short term, Friday's intraday reversal, and what I mean by intraday reversal, as you said, you made a marginal new high, but you were unable to hold on to those gains, and we closed towards the lows of the session. Something else to consider is if you look at the rate of change indicators from an RSI to a stochastics, you've also seen lower highs there. So all those sort of points that we have seen some slowing upside momentum, and what we should expect is at least some kind of pause and consolidation in the Nifty. The support area that we see coming through is around the 21,000 to 21,300 area. So that's the bottom end of the range. And I think that would sort of be the best case scenario, that we're just going to a holding pattern down towards that support area and just have a time-based correction before the breakout. And remember, the breakout from the 2021 to 2023 trading range still has an unmet upside target of 23,000. So short term, yes, I think a bit more volatility and a correction is due. But longer term, there's still another upside target of 23,000.
Okay. Hi, Lawrence. Good morning. Lawrence, the near term, if we could be in for a bit of a correction, how deep can we go? The Nifty is currently at around 21,800. So how low can we go?
So basically 21,000 to 21,300 is where support is. So 21,300, the significance of that is the 50-day. And then the lows that you made in December, as well as the lows in early January, sit around that 21,000 area. So that's what we would sort of define as the bottom end of the trading range that the market can hold in. And that would be a shallow time-based correction. Clearly, if you break below 21,000, that's when we run into a deeper scenario where the next support area comes through at around the 19,800 to 20,000 area. So that's roughly where the 200-day is, as well as the August-September high from last year's. But at this stage, looking at how the market's trended, it's taken the time-based correction, meaning you go sideways in a trading range. So that would be our base case on what we're seeing currently, and more rotation beneath the surface. And that's why the market takes a pause rather than a more significant decline, because you're getting rotation beneath the surface.
Okay, that's interesting. So you're looking at short-term volatility, and you're seeing in the shorter term, perhaps a corrective phase is upon us, but in the medium term, there is a big up move. What about the Bank Nifty? If there is a corrective phase, do you think that would be led by the Bank Nifty, and what are the levels to watch there?
Well, it's interesting. It has been led by the banks, and talking about rotation within the market. If we just look at the Nifty and take the two largest cap stocks within the market, HDFC Bank and Reliance. HDFC Bank's post results has turned sharply down from the top end of its 3-year trading range, which is around that 17,030 area, and the downside of that trading range is back at the 1,300 area. So we think there's still downside risk there. But then on the other hand, you've got Reliance breaking out of a 2-year trading range that you've still got upside targets of 3,400. So you can see those two market moves of the large cap stocks squaring off and keeping the Nifty in the current trading range. But to go back to your question on the Nifty banks itself, you do have support around the 44,000 area. That's roughly the 200-day and the most recent lows. And if you did break below that, we're talking about a move down to 42,500. But it's really the private sector banks that have been weakest, dragging that broader Nifty banks index lower.
What's the level on HDFC Bank? You said that there is some more downside left, right? Is it 1,200 that could be a base, or could it get worse on HDFC Bank?
Yeah, so there's strong support that comes through at the 1,260 to 1,300 area. That's the bottom end of the 3-year trading range. But we do expect to see a test of that level.
Lawrence, we'll ask you for your positional ideas in terms of specific stocks, etc., what you like and what you'd like to, on both sides in a bit. But how are global markets doing? Your view on the US 2-year, 10-year, whatever you track, and equities, the S&P and the NASDAQ.
Yep, so let's start off with the 10-year yield. And what we saw post the reaction from the non-farm payroll numbers in the US Friday is you've clearly got this new support area in the 10-year yield, which sits at 3.75 to 3.78%. And the upper boundary of this new trading range for the 10-year yield comes through at the 4.16 to 4.3. So we are seeing the 10-year yield settle in a new range, and a slightly higher range than what we saw through last year. And what that's mean from a global standpoint is it's been quite a selective market advance at the start of this year. So, if you look at global markets that have performed, Japan been up there with the AI NASDAQ related stocks. And obviously India has also participated in that move. But you've seen US small cap stocks, which outperformed in the fourth quarter, being negative for the year. So again, like you've seen rotation within the local market, you've seen rotation within global markets, which have also centered back to growth AR-related stocks in the US. And on global basis, you've seen Japan, India, and Mexico, again, be the outperformer. So a very select handful of markets with yields holding in a higher range. I think for a broader rally in global markets, you need to see yields declining again, and that means a break below 3.75% is what you're looking for on the 10-year yield.
All right, that's going to be the trigger for global markets, and 3.75% on the 10-year yield. Lawrence, you said, we could be in for a bit of a correction, and then we go back up to around the 23,000 odd mark. And Reliance Industries, as you pointed out, has been one of the top performers. What are the levels you're looking at in terms of Reliance Industries? Where does it go?
Yeah, so the breakout of the 2 and a bit year trading range that you've seen recently with the move through the 2,800 area gets us an upside target of 34 to 3,500. So we still see further gains for Reliance, strong momentum. And like I say, that contrasts to the price action you've seen in the private banks, particularly HDFC. So, those two are sort of cancelling each other out at the index level, leaving it range bound, but Reliance still has that 34 to 3,500 rupee upside target.
Do you have any thoughts on Tata Motors? It's been the big breakout story in the last 1 year. It's doubled and now almost 1,000 rupees. Are you tracking the charts and do you see further upsides here?
Yeah, I don't have any fresh upside targets on that name, but obviously has strong momentum, which reinforces the uptrend. So would continue to give benefit of doubt to that uptrend that is extending within that space. Again, within autos, it's a far more select handful of stocks sort of driving to the upside. We've seen a few more roll over, like Maruti Suzuki and Bajaj Auto, which is showing some slowing upside momentum. So again, more selective, but Tata Motors is showing strong upside momentum.
Okay, that's on Tata Motors. Anything else that catches your eye, Lawrence, in the Indian markets? You spoke about HDFC Bank on the downside. You talked about Reliance. What about some of these IT names? Do you see them coming back into action in a big way on the technical front? And anything else from the index that you would like?
Yeah, IT is essentially in a holding pattern, and it is outperforming the banks, and that's because they're currently holding trading range levels post their results. But it's not as if we're getting fresh momentum signals like we've seen the breakout in Reliance. But if I can sort of share, gain through the rest of 2024, I think one of the key drivers from an emerging market side is emerging market small cap stocks. And if you look at emerging market small cap stocks versus developed market small cap stocks, November last year, we actually broke out of a 3-year basing pattern. And that basing pattern followed 10 years of underperformance by emerging market small cap stocks. And within the emerging market basket, Indian small cap makes up the biggest weighting. If you look at the iShares India small cap ETF listed in the US, you've broken out of a 3-year trading range. And that gives us an $84 to $85 upside target. So, in this volatility that we've seen in the short term, I think investors can look at adding exposure to Indian small cap stocks via that ETF, or obviously at the individual stock level. But I think that's a space that can continue to work within India. And, you can use weakness in this volatility that we've seen currently as a place to pick your spots to add exposure.
All right, we'll leave it at that. Lawrence, thanks a lot for joining and appreciate your thoughts here on CNBC-TV18. Well, that's the word coming in on the technical side of the market. Lawrence Belanco stating that this market could see some volatility in the near term, but the longer term trend is intact. Don't lose sight of what's happening with a couple of stocks. Paytm is at a fresh record low. As expected, that stock once again is under pressure. UPL is down almost 5%, and on the upside, it's Tata Motors that's up about 6% post its numbers. Let's talk about Dr. Lal PathLabs, though. The Q3 performance was quite disappointing. The revenues came in below street estimates. Non-COVID growth is also quite subdued. Dr. Om Manchanda, the MD of Dr. Lal PathLabs, joins us now to discuss their Q3 performance. Dr. Manchanda, thanks a lot for being with us on the channel. I want to first start by asking you about the impact that competitive intensity has had on your industry, especially in some of the key markets like NCR. I ask because over the last 4-5 quarters, you've seen subdued growth, not just from your own company, but across the industry. Do you think things could get worse before they get better? And what is your own expectation on volume growth? I mean, this time it was 5% for the quarter. Is this something that you'll have to work with for the next few quarters as well?
Good morning. Thanks for having me here.
I think within the industry, we are industry leaders, and our growth rates have been pretty good, double-digit for both on quarter as well as on YTD basis. The growth actually has come from across all the regions. And your question related to competitive intensity, I think over the last few quarters, we have seen sort of a subdued competition. And many of these people also have taken price increases. So I would actually say that our quarter, while it's been lower than expectation on volumes, but in terms of in terms of value, I think it's pretty in line with what we expected.
But do you think you will be able to do that double-digit growth that you had stated earlier? Is that your stated guidance even now by the end of FY24 and FY25 on the top line?
So both on quarter as well as on YTD, our value growth is double-digit. We are nearly about 10%. And this is coupled with both volume as well as revenue per patient. And revenue per patient definitely has impact of price increase, which we took last year. We hope to actually improve our performance and volumes going forward, but we're still very hopeful that we will be able to meet this double-digit number.
Right. Dr. Lal, generally the belief is, morning Prashant here, that you will outdo whatever industry grows at, right? Now, could you give us some ways, I'm talking about volume here, could you give us some sense on what that might be? How do you think about that number? What will the industry do and what will you do on top of it? And also on prices, where are we at, sir? Because I don't think you've taken any price increases in the past year. And when will we see any increases? When is it going to be possible? Go on.
Actually, volumes have two components. One is number of samples, number of tests that we do. That number has grown very significantly, nearly about 7-8%. It's the number of patient visits. It's not about unique patients, actually number of patient visits. Now that footfall can actually be impacted by disease incidence, season per se. We've also seen some impact of bundling on the footfall. I'll give you an example of, let's say, fever panel. Earlier, people would come for individual tests like dengue separately, malaria separately. Now we have one fever panel, so one visit does it all. So to that extent, volume definitely gets impacted. So I would say that we are looking at revenue per patient being impacted by multiple variables, not just footfall. And the number that you see on volume growth, actually, it's not about unique patients. These are all about patient visits to our lab. Now, since you know that our industry is need-based, it's not a want. So as and when the need is there, people would come. So overall, we have seen in the industry, the volume growth has been subdued compared to last couple of years. Now, there's been one hypothesis that is there any fatigue setting in because after COVID, people want to give it a pause. There's so much of testing that has happened. So let's see how it goes. But I think overall diagnostics will continue to remain the mainstay within the healthcare.
So the thing to watch is what? Sample? Is it, when we say volume, is it the thing to watch is what? Samples, number of patients, or revenue per patient?
I would say actually all revenue per patient, because that's a combination of many things. It's a footfall. It's also a mixed change because a lot of high-end tests being ordered now as the medicine goes into evidence-based. So you will see that higher order tests being prescribed also does impact revenue per patient. So there are multiple factors at play in terms of pushing the revenue per patient up. And we have seen the bundling, which is our SwasthFit, nearly about 30 tests in one go and actually pushes up the revenue as well. So there are multiple variables at play to look at it. So volume alone is not the variable.
Okay, all right. Good morning, Dr. Manchanda, and always good to see you in. Since you spoke about SwasthFit, let's take that forward. It currently contributes close to 20% of the mix. It ends the year closer to around 500 crores in terms of revenues. I wanted your thoughts on that. And what about next year? How do you see this scaling up? It's scaled up beautifully till now, but on an annual basis, what kind of revenue number will you be looking at from SwasthFit?
SwasthFit, I think last 2-3 quarters, we've seen it's stabilizing, as you rightly said, about 19-20%. I don't see this number now sharply moving up. We are seeing one very interesting trend now of bundling on higher-end tests. So far, it's been more on routine tests where patients can, on their own, come and get checkup done. But I have seen even within the medical fraternity now, they are looking at bouquet of tests which can actually help them diagnose something early and in one go itself. So we are seeing some pattern of demand of bundling happening on higher order tests as well. In terms of growth going forward, I think it's a very well laid out strategy that we keep repeating often, which is about go deeper in northern eastern markets. That's where our brand is very strong. And you must have seen that we've been talking about tier 3, tier 4 towns. And I think the entire state of UP, Bihar or rest of North, we are just going deeper as much as possible. Go wider in South and West because those are the places where our brand is a long way to go. And we are looking at some of the larger towns. And that's where our whole inorganic and organic both strategies come in play.
All right. And tier 2 and tier 3, currently, how much do they contribute as a percentage of your revenues? I think it is around 30%.
Yeah, we've started giving this data for the last 2-3 quarters for our own sort of growth, for our own tracking as well. Nearly about 30% of our business is actually coming from that part of the pop strategy.
And it's growing at what clip in comparison to the NCR region?
I don't have that number exactly, but definitely it's higher than our portfolio growth because that's where the large population is for us to drive.
Okay, Manchanda, just that point on higher order tests, what do you mean? Sorry, I didn't quite understand. Are you saying that medical professionals are ordering them, or are you saying that expensive tests are being bundled together via these packages?
No, what happens, I know it's a little technical in terms of, let's say, someone who comes from a cancer test. Now, normally, earlier a test will be prescribed for histopathology. Now, a test is also being done for histopathology as well as gene sequencing. So, they are all clubbed together. So, from the same sample, medical fraternity or doctors would want to have all the tests being done rather than samples being sent again and again. Though that's the early stage, but I do see that pattern happening.
Okay. So, overall, I just wanted to understand that you did mention that competition has eased a bit, but how is the online aggregator competition at the moment? Because, in the last 12 to 18 months, there was a big spike up that we saw in terms of online aggregators. Has that eased as well? And what do you think is the way forward now? What are the, consumption patterns looking like?
So let me correct myself. I don't think competition is eased, but I think I would say it's become level playing. They're all there. Earlier, I think there was a lot of deep discounting which was going on, and I think that is probably coming down. But competition is still there. This industry has always been very competitive. While some of these competition is visible that you and I see, but there is a very highly unorganized unorganized industry as you go down the pop strata. So competition is pretty much there because the entry barriers are not that high in this space.
So this revenue per patient, right, that you were talking about a while back, do you think it will be hard to scale that up given the kind of competition that is present?
I think so far, last 4-5 years, industry has not taken the price increase, but over the last sort of a few quarters, we've seen some trend towards that. So to my mind, I think ability to take price increase on some of these tests may be easier now going forward. Second is, as I mentioned to you, the mix is also changing. It's just not routine tests which are being ordered now, high-end tests being ordered. That's also a favorable impact on revenue per patient. But I would say that as a company, we would definitely keep an eye on expanding our footprint and keep our value proposition or price value equation very, very strong. So to me, pricing definitely would be a last resort. Now, coming to your question of revenue per patient, I think we'll have to see as we go along. But it will be a combination of both volumes and RPP here.
Final question from my end, Dr. Manchanda. Give and take everything, the industry dynamics, the way you are running your business as well, changing the mix. What is the sustainable margin outlook from here on?
Absolutely. I think you see the number this year. We have expanded our margin profile, both operating margin as well as net margin. We run our business very efficiently, and we will continue to do that. We have actually brought in a lot of technology to run our processes very, very efficiently. We'll continue to do that. And we should operate within the range of 25-26%, although we are hovering slightly higher than that. But I would definitely reinvest some of that back into growth.
All right, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts here on CNBC-TV18. By the way, there's so much that's happening in the market. So let's take a look at a couple of these stocks. Interglobe Aviation actually is the one that you should be looking at. Big moves coming into those stocks now, aviation stocks. It's not just aviation, it's an entire travel space which is doing very well. Interglobe is up about 5% of course, post its numbers. But take a look at some of the other names, right? I think Lemon Tree is also at a fresh high. I just saw that quote on that one. Look pretty strong, 2.5% higher. Fresh high on Lemon Tree, up 22% right now. And Interglobe Aviation is also at a fresh high, up about 4.5%. The thing about Interglobe is that the numbers are very strong on all fronts. It's the 5th consecutive quarter of reporting profits for Interglobe Aviation. And as I said, it has 80% market share in some of the monopolistic routes. So Interglobe Aviation, is the biggest beneficiary of this travel boom that we're seeing. Revenue growth of 30%, EBITDA up 61%, margins have improved substantially, and profits have doubled on a year-on-year basis. So this stock is, one name that the street definitely likes today.
Okay, all right. Well, let's focus on LIC Housing Finance then. Quarter 3 was rather weak showing, with disbursements declining on a year-on-year basis, and AUM growth as well has slowed down. Mr. Adhikari, the MD and CEO of LIC Housing Finance, joins us on the show. Hi, sir. Good morning. Thanks so much for joining in. Well, give us a brief idea in terms of disbursements on a quarterly basis. What should it look like, in the coming quarter and from year on? And also, could you guide us in terms of AUM growth? What do you end this year with? That's FY24 as well as FY25?
Looking forward, I think I'm very positive. The company will continue to do well. We have been doing well as far as the profits are concerned, much above what we have done in the last entire financial year to put together. As far as the AUM book is concerned, yes, the growth has been tad slow. But I think we need to realize that this has been a year of consolidation for LIC Housing Finance. At the beginning of the year, we went in for a major technology upgrade. We also went in for a large-scale restructuring of the organization. So put together, it has been a year of consolidation. Quarter on quarter, we have seen growth in our business. Yes, the AUM growth stands at 6%. Q4 is going to be better, much better than Q3. But the consolidation will go on forward. And looking forward to FY25, I think we will start delivering in FY25. All right, Mr. Adhikari, steps we've taken, the technology upgrade, the restructuring, that will bear fruit in the quarters of FY25, and I see a guidance of at least a growth of 15%.
15% AUM growth, right? 15% AUM growth, Mr. Adhikari, for FY25?
Yeah, FY25.
Got that. And could you tell us, what is the current ticket size? What's going to drive this growth going ahead in terms of disbursements as well? Will it be volumes, or do you see the ticket size as well going up?
Well, our current ticket size is around about 25 to 27 lakhs. That is the ticket size. Yes, I do agree, slightly on the lower side as compared to my peers. Yes, we are definitely looking at increasing the ticket size, moving on to bigger markets. A major thrust this year has been on growing our distribution channel. We have been seeing some traction in that. Distribution channel has grown, so that should bear fruit. Yes, next, it's not going to be very huge. We're not going to jump from 25 lakhs to 50 lakhs or something like that. But definitely, there will be an improvement in the ticket size. And there will also be a growth on the loan book also. As I said, guidance of about 15% growth in the loan book in FY25 is what I'm looking at right now.
Mr. Adhikari, good morning. Prashant here. Could you talk to us a little bit about, what are the kind of spreads that we should kind of model in, that you will make? They're at about 2% right now. They're high. They're higher than what you have done in the past. Is it sustainable? Should we expect this to go down going forward?
Going forward, I believe it will be slightly moderate. It will moderating, I think, and maintaining these spreads. We'll be doing well as far as spreads are concerned, 2% right now. But I don't expect a major change or a moderation in these spreads. Should of course, the aim and attempt will be to try and moderate it. But this is largely driven by retail. The spreads are largely driven by retail loans, which we've been selling. In the coming years, 85% of my book is on the retail side. Looking forward to diversifying this in the coming fiscal. So I think spreads, yes, should be more or less there. Don't expect a big downslide in the spreads.
So back down to what? I mean, 1.5% from current 2%? Is that something like that, in that vicinity?
Yeah, somewhere on that.
What is the current cost of funds, sir? And how do you see that moving from here on?
From here on?
Yes. So what is the current cost of funds? Say in the last quarter and the previous quarter, what was the cost of funds and how has it moved? Because that in turn will impact your NIMs, right?
Well, the cumulative borrowing cost is around about 7.70. at the end of the quarter. Yes, there will be pressure on the cost of funds, I believe, but I don't expect a big downslide in the previous quarter. There hasn't been too much of a sort of increase in the cost of funds. The NIMs were okay, restricted only. We went down by just 4 basis points. So I expect the cost of funds to hold at the current levels of 7.70%.
And that means NIMs will be stable around this 3% mark.
Yeah, the NIMs, 3%. We've done well, I believe, in NIMs as far as the NIMs are concerned. Just down by 4 basis points in the current quarter. Yes, there would be a pressure on NIMs, but I don't expect too much of a sort of worsening of the NIMs. At the most, 10 to 15 basis points at the most. Guidance of 2.8 plus is what I'm sure we'll be able to deliver.
Got it. Final question before we let you go then. Give us a sense in terms of how does asset quality and credit cost guidance as well from here on?
The asset quality has been improving. Yes, this was a major, I think, worry for all of us when we started the year. The quality was not good, especially on the project or the builder loan book. Yes, we have been working hard. We have taken steps, wherever possible. There have been negotiations going on. A lot of positives on the negotiations front. Then again, wherever possible, we have taken legal action, whatever is available to us, whatever legal recourse is available to us. So yeah, asset quality has improved, and going forward, I see a continuous improvement in the asset quality.
All right, Mr. Adhikari, we'll leave it at that. So 15% AUM growth for FY25, spreads around 1.5, NIMs around 2.8. That's broadly the picture coming through from you. Good luck, sir. Thank you for joining us here.
Thank you so much.
Okay, well, the market's booming. Look at the Nifty. 70 points now, 21,920 is where we're at. We're at the day's highest point. So slow start, but never rule it out. Never rule, the market to do its own thing, right? The day's high, which is a new all-time high on Friday from where it cooled off, was 22,126. We're at 21,925. So, I mean, that was a big move on Friday, but this is looking strong in any case. So.
I just want to mention, the stock of the moment is UCO Bank. Just pull up that chart. It's 17% higher now on UCO Bank. And I mean, ever since UCO Bank came out with its numbers, actually, the loan growth was very strong for that particular bank. The NIMs were stable, etc. But today, I think numbers came last week, but today the stock is really piling on the gains. Just look at that, 17% higher.
Just one point on UCO Bank, Sonia. There's only 3% in the open market because the government of India has more than 95% and LIC has 1.5%. So the float as well very limited. But as you said, the numbers look quite good.
Oh, absolutely. Even IOB, 13% higher there. So
PSU
it's
banks,
it's the day belongs to PSU banks. Let's do one thing. Let us take a quick break. On the other side, Arun Maheshwari, Joint MD and CEO of JSW Infrastructure, will join in to discuss their Q3 earnings. Stay tuned.
News that's coming in there on Shree Cement, and that explains why the stock has moved to the low point. Sources tell us here at CNBC-TV18 that the Income Tax Department has issued the final notice to Shree Cement post the completion of the probe, and the IT department has issued a notice to Shree Cement in January for approximately 8,500 crores of tax evasion. And they had conducted, remember, the search in the middle of 2023, that is June 2023. And from then, the stock has been a little bit nervous. And now it explains why the stock has moved to the low point of the day. The tax liability, however, that's the important number that comes up for you on the screen. The tax liability could be to the tune of close to around 4,000 crore rupees odd. So this has been an ongoing thing. And now we have a few numbers that are flashing for you on the screen. Tim C will join in and give us further details. I'm reaching out to Mr. Bangur as well and team and trying to get a response on that front. Prashant.
All right. So more on this in a bit. Look at the market, 90 points now on the Nifty. I mean, we took that break. We were up 70, make that a full 90 points and approaching the 3-digit gain mark now on the index at the day's highest point. I mean, we've been trading for less than an hour, to be fair, but it's picked up quite a bit. JSW Infrastructure reported a good set of earnings for the third quarter. Their revenue saw a healthy jump, while margins also expanded. Arun Maheshwari is Joint Managing Director and CEO of JSW Infrastructure. Is joining in right now to talk about the earnings and how the picture looks ahead. Mr. Maheshwari, great to have you with us here. Good morning. Thanks for your time. Could you talk to us about the big drivers behind the volume growth and the top-line growth that we've seen in the third quarter? The newly acquired assets have started contributing to the overall revenues. To what degree? Can you provide us with some numbers?
Acquisitions, what you have seen, has not really contributed in this particular quarter, which has recently gone by, because those assets were just about 10 days or 7 days old. So that addition to the volumes are very insignificant. The large part of the volume growth and the revenue growth has come in from the utilization at our Paradip assets, which is iron ore and coal assets, and some decent volumes pick up in all other ports. There has been a significant increase in the utilization of the coal terminal, which is just about the third year of operation now, and iron ore, which is the fourth year of operation. So these are the new terminals which were added about a couple of years back in our portfolio. And a very modern terminal, the utilization has started growing right from day one. And this quarter, we have seen significant jump in those volumes as well. So that has really largely contributed to the volume growth for the quarter.
So what was the proportion of the third-party volumes in Q3 and what was the intergroup volumes, if you can just help us with that?
So the third-party growth of cargo is a combination of liquid containers as well as bulk. If I had to look at the bulk side of it, iron ore and coal, as I said just now, is all third-party largely coming in from Paradip. Container terminal, which is relatively new in our portfolio, is just about 1.5 years of operation. It has been going steadily going upside. So it has added to one more volume. Liquid, as such, we didn't have anything in our portfolio. So I don't see any growth getting contributed from liquid side in this quarter. However, the coming quarter, you will see liquid coming in because our acquisition of Fujairah Oil Terminal, which is just about 10 days old as on 31st December, the full quarter impact will come in this quarter. So you will find a liquid contributing our growth journey from this quarter onwards.
All right, so new assets have been acquired in quarter 3. So what will the growth be in quarter 4 on a year-on-year basis? And how much will they contribute to your growth? Give us a sense of FY24 guidance.
New assets which we have acquired, they have been running successfully almost on 90% plus capacities. However, if I have to look at PNP as a port which we have acquired, which is a 5 million ton capacity port, it has a approval of up to 19 million ton, 19. So once we have stepped in, now we would like to mechanize, modernize, and we would like to scale up that port. So the potential for that port is up to 19 million ton as we talk today. So we will have to make a layout of the capex plan and the more marketing of that port. By virtue of this port will grow further from here on. Coming to the oil tankers terminal, that is running at 90% plus capacity utilization. However, there is an additional piece of lease land which we can acquire over there, and we can build additional capacity over in that terminal, which we are assessing now. How do we do that? So these are the two upsides available on these two acquisitions, what we have done, other than what the synergy we can bring in from our existing assets in those terminals. Coming to the quarter 4, typically in our industry, quarter 4 is strong as compared to last 3 quarters because the quarter 1 and quarter 2 are generally monsoon in India. And quarter 3 is slightly better. And quarter 4 remains the robust one because of the large contracts, take or pay, and everything gets built into the quarter 4. So the volume, what we have seen in the past, has been generally better in quarter 4. And we don't see any significant change from that trend in this year also. So I think quarter 4 should remain good.
Mr. Maheshwari, let's talk about the Keni and the Jatadhar ports which you recently secured. What sort of development capex will we see there? Will you have to do? And by when will these sort of become, the expansion of the ports be complete and they start contributing?
Keni port, we just signed the concession agreement in the month of November last year. And we have already started working towards the environment clearances and other related clearances for that port. Hopefully, all the clearances should be coming in another 6 months or 1 year time kind of stuff. And thereafter, the project construction will commence. Typically, it takes about 3.5 years to construct a port. So from today, if I have to look at it, about 3 to 4 years kind of time frame, I can say, for Keni port. And the total capex outlay as projected is about close to 4,100 crore rupees for that. So thereafter the volume will start picking up over there. Coming to Jatadhar port in Odisha, this is the concession, all the approvals are in place in that case. The concession agreement is likely to be signed within the next 4 to 6 weeks by JSW Utkal, which is a subsidiary of JSW Steel. Once that is done, then we'll apply for novation, and thereafter we'll start constructing the port. So given the time frame and what we expect, it should be again another 3 to 4 years time, we should be running that port as well. And in that port, we expect to spend close to about 3,000 crore rupees. So total both port put together close to about 7,000.
All right, sir, we have to ask you this final question before we let you go. Our team had reported your intention to acquire Navkar Corp recently. Could you clarify your interest in the company and also your inorganic growth strategy from here on?
See, the thing that, being a big player in this industry now, and with an appetite to grow with a strong balance sheet with us, we keep exploring multiple opportunities, and many opportunities keep coming to us. Not necessarily that it is one or the other opportunity. So I would not like to comment on any specific opportunity as of now, but we do have an intention to get into that last mile connectivity space and all. That's why we have purchased a CTO license, and we have been exploring several other opportunities wherein we can differentiate from the existing only port operator to a service provider till the last mile connectivity. So I would like to rest my comment over there rather than getting into any specific opportunity which we are exploring or not. As the time passes, probably we can discuss more about several other opportunities which we are looking at today.
Okay, we'll let you go on that note. Thanks a lot for joining in. That's JSW Infra. Let's look at the market still holding steady actually. Bikaji Foods is the other stock that we're looking at this morning. Q3 was a good quarter for them year on year. The growth was led by the packaged sweets business due to a shift in the festive season. The company's COO Manoj Verma and the CFO Rishabh Jain join us now to discuss their Q3 performance. Gentlemen, morning to both of you, and thank you for being with us on the channel. Manoj, I want to start with you because, overall, you had targeted for the full year, FY24, your volume growth would be at 18%. And in 9 months, your overall volume growth is already almost 17%. So would you want to scale up your full year volume guidance? If yes, how much do you think you can do? And what's your early estimate of what FY25 volume growth could look like?
Good morning, everyone, and thanks for the opportunity again. Yes, indeed, this quarter has gone very well for us. Now, if you look at in terms of volume growth, has been ever highest volume growth, which is a number of 29.5%. Well, in terms of outlook for the year, if I was to say for what we said, we will stay now around it. Quarter 3 is very, very high for us because of, as we said, that there's a shift of Diwali and gifting sweets did extremely well for us. So which has brought in huge contribution to it. But yes, the year will end around the numbers what we spoke about. Talking about next year's number, now if we were to look at, so we would look at say around 18 plus minus % volume growth next year as well.
Okay, so you're saying FY24 also you'll stick to 18% and FY25 as well you're looking at 18% growth. Got it. Just one follow-up there.
18 plus minus, yeah.
18 plus or minus, okay.
Yeah.
Which is the segment where you're seeing this quarter, of course, packaged sweets has done very well because of the shift that we've seen in festive season. But between ethnic snacks, packaged sweets, Western snacks, which is the segment that is growing the fastest and where, expectation is that growth will pick up?
See, gifting and sweets is basically, more dependent on the Diwali and festive around, right? Howsoever, we don't miss opportunity on these categories. But the core to us is our ethnic snacks. And that's where if you look at even in this quarter, the volume growth has been 19%, which is extremely, extremely good. And a value growth of 15.4%.
All right. Hi, good morning, gentlemen, and good to see you all in. What about margin guidance from here on? Is the best of, the lower raw material cost already in the price, or do you all think there's more to come?
Thank you very much for taking us. So basically from bottom line perspective, we are on track for this year margin profile. And that's what we targeted early year and budgeted we will be at close 13% type of EBITDA. And this quarter, normally you will see in second, third quarter, our ad cost spend go very high. normally 70% of overall year spend goes in these 2 quarters. So normally, and also there are few raw material which the price has been increased, like chana dal and everything, which has impacted us close to 0.6, 0.7% in gross margin. But overall, we are on track and we'll be on a margin profile. That's what we're targeting.
So margins will be approximately this 13 to 15%. Could you give us a number? EBITDA margins, Rishabh?
Yeah, so from EBITDA perspective, at a full year level, we'll be upward of 13%.
Upward of?
13%.
13%. Got that. Also, you had commissioned this new facility, frozen facility in December. That was as per plan. It has a huge scope in terms of revenue out there, revenue potential. Could you tell us utilization levels? How does it move from here on?
So basically, in next 2 quarters, so of course, it's as per plan, we have installed the capacity, and in next 2 quarters, we'll do a lot of new product innovation in that plant, because frozen in new capacity which we have built in. But yeah, this can bring a good revenue in next 2.5, 3 years. So it can be a potential of plus 200 crore of revenue in next 3 years.
Okay, gentlemen, hi, morning. Prashant here. Actually, one big lever for you is, your distribution, right? How many outlets do you have, and direct outlets, and where all you are present? That'll do the trick. The product, I don't think, needs much pushing in that sense. So just give us a sense, Rishabh, in terms of just the overall touch points, direct distribution. What's the aim?
Yeah, so basically, from direct distribution perspective, currently we are at close to 2.5 lakh outlet type of thing. Our target is to be at close to 3.5 lakh outlet in next 2 years. And our total reach is around 10 lakh outlets, what we have as of now, but our target is to be around 12.5 lakh outlet in next 2 years. It's important thing, and that's what we are focusing on. We have built a team in last 1.5 years, added more than 300 plus sales team in our overall strength, total sales team strength. So that's where we are focusing on. Largely, our 70% revenue comes from 3 states, Assam and Bihar. And that's where we have a lot of scope in core state, as well as a lot of scope in our focus state. That's where we are focusing on.
So when we say direct distribution, Rishabh, that means outlets, own outlets?
Not own outlet, but that's where our own sales team goes and visit the outlet. That's long connectivity in our own DMS.
Okay. Just 2 quick questions before we run out of time. One, if you can tell me, what is your current market share, Rishabh, in the core markets that you are in, and has it gone up since the last time we spoke?
Yeah. So overall, from core market, our average business share is close to 43-44%. Where in Assam we have plus 55%, in Rajasthan we have 47-48%. So, but of course we have grown in our business share compared to last time in last 1 year.
Okay, so 43-44% core market share is what you said, right? And can you tell me what is the scalability that you're seeing in the recent acquisition you made of Bhujia Lalji? What is the expectation of growth there?
So Bhujia Lalji, so it's a small company, and it's a big scope to grow. Our target is to be this company can become 100 crore top line company in next 3.5 years. That's what we're targeting on.
Okay, gentlemen, thanks a lot for that. Next time, maybe we can focus on the export market. Why should we just enjoy crunching all the snacks out? Yeah, thanks so much, and appreciate you joining in. For the time being, slip into a short break. You come back, we'll get you our focus on the commodity markets as well. Stay with us.
Welcome back. Well, let's get a quick handle on what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, Sonia, I'm looking at the global food price index, and good news from there because the food inflation globally seems to be coming off. So when you look at the January FAO food price index, it has declined to the lowest level in 3 years, and we have seen a decline coming in yet again. It has fallen by nearly a percentage point on a month-on-month basis and 10.4% on an year-on-year basis. So the food inflation globally for major price indexes seems to be easing off. There is strong competition among exporters is one thing that we've been looking at. Second is the Chinese demand is not so strong right now. Third is that there is arrival of recent harvested supplies coming in from the southern hemisphere for most of the producing countries. So there is enough food into the global markets right now. How does the global trade pan out? Well, that's something that the street will watch out for. And also, when you look at the global food index in numbers, that is in the negative territory since November 2022. So we've been seeing gradual flattish kind of moves since in last year or so in those markets there. So when you look at the vegetable oil, it has seen flat moves in the month-on-month basis, but on an year-on-year basis, it still is 12% on the weaker side. Dairy, same story here as well, flat on a month-on-month basis and a 17 to 18% of a decline on an year-on-year basis here as well. Meat also has seen a decline continuing into the markets there, 1.4% of a decline. It's a 7th straight month of a fall there as well. Sugar is something that has seen positive trends though. We have seen almost a percentage point of gain in the index on a month-on-month basis and 15 to 16% of a jump on a year-on-year basis still showing there. This is because there is support because of Brazil weather, and also the kind of curbs that we have in Thailand, in India is keeping the sugar prices quite supportive, and the markets are quite bullish onto that one going forward as well. Take a look at the cereal markets, and we have seen more than 2% of a decline globally there. The wheat and maize prices have seen a decline, but when it comes to the rice prices globally, that continues on a firmer note. In the Indian markets as well, we are looking at the rice prices trading at a multi-month highs there. The cereals, though, has a positive story because when you look at the world production, it's a record 1.2% of gain expected for 2023. The consumption also is expected to see a gain, but the global inventories are at a comfortable levels there. For the Indian markets, it has been about various steps taken to ensure that the inflation has been curtailed. We have seen export curbs come in for sugar, wheat, rice, onion, etc. And there is almost 0 to 5% import duty that we've seen in pulses and edible oil as well. I want to quickly take you through a last table, and this tells you on how the central pool is right now when it comes to wheat and rice holdings. So we had strongest of holdings actually in 2022, and then we've seen sharp decline that we saw in the previous year at 23. This is a multi-year lows when you look at the wheat stocks with the government and for the rice stocks as well. So for 24, the estimates are that we're going to be better than where we were in the previous year for a couple of those commodities. Wheat, of course, is a bit of a concerning situation even now, and we are sharply down as a yearly average that we've seen onto this one. But because we're looking at a better crop this time around, the expectations are that you could be looking at stabilizing prices for this one as well.
All right, let's do one thing. Let's take a short break on that note. On the other side, Lata will get chatting with Santanu Chakrabarti, the banking expert from BNP Paribas, to review their Q3 earnings performance of banks and NBFCs and their outlook here onwards. Stay tuned.